All right, welcome back. Thank you for joining us. My name is Jason Nagel. I am the founder of 360 Wealth, a family office located here in Calgary, Alberta. And today I'm going to be talking to you about the tax implications of gifting a property to a child. So recently, a client of ours approached us about gifting this rental property to one of their children. Due to the prices of homes in Calgary, they thought it would be really nice to be able to help their child out by gifting this property to the child. And since they were gifting the property, they didn't think that there would be any tax implications to doing so. All right, so I'm going to give you the fact rundown. So they've owned this property for several years, and over that period of time, they rented the property out. They bought it for, let's just say, $300,000 initially, and that's their adjusted cost based on the property. And right now, the fair market value, let's just assume, is going to be $500,000, okay? So when they gift that property to the child, even though the child did not pay any money for it, all right, the parents are going to have a deemed disposition on that property. So the fair market value of $500,000 is what they're deemed to have disposed of it for, and the adjusted cost base, the price they paid, is their tax base. So they're going to have, in my example, a $200,000 capital gain. And with current inclusion rates, 50% of that capital gain would have to be included into their income and taxed in the year that they gifted it. So that's a really important consideration to make sure that you're aware of. The other part of it is that many accountants with rental properties will claim what's called CCA, capital cost allowance. And CCA, very simply put, is going to be a little small deduction that you get that's supposed to account for depreciation of the property for the time that you've owned it. So it saves you a little bit of money in taxes every year. But when you sell the property, if you sell it for more than the undepreciated capital cost amount, you're going to have what's called recapture. So in my example, let's say that you bought the property for $300,000, and over the period of years that you've owned it, you've claimed $50,000 in CCA. Well, when you sell it, and if you sold it for, or not even sold it, sorry, but when you gift it over to your child, you're deemed to have recaptured all of that. And so recapture means that all of that CCA claimed, the $50,000, gets added back to your income, taxed at your marginal tax rate for that year. Okay, so just know that gifting a property to a child is not just, you gift it over and therefore there is no tax payable. There is considerable tax payable depending upon the situation. So in my example, this family would have had $50,000 of recapture that would be taxed at their marginal tax rates, possibly split between both spouses if the property was jointly owned. And they would also have a $200,000 capital gain, of which 50% would be taxed at, once again, each of their marginal tax rates if it was jointly owned or whichever spouse owned the property. So just some things to consider. Thank you for joining us.